Gold price measured in dollars rising. So we're talking about the relationship between real money without counterparty risk and credit. Secondly, we've got the long bond yield, which will break out above that 5.1% level, I think fairly shortly. Could be within weeks. And thirdly, we've got the extreme valuation disparity between the yield on the long bond and what's going on in equities with the S&P hitting new highs. Who cares about valuations? We're going to buy because it's rising. And you got the speculation in Bitcoin and all the rest of it. I mean, this is a speculator's market. It is a credit bubble. When that bursts, it's going to have a profound effect on the dollar.
In today's news recap, China proposes rule changes to ease gold imports and exports. China sought to ease licensing rules for gold imports and exports as the world's largest consumer of the precious metal continues to diversify its reserves away from U.S. dollars. The country plans to expand the use of multi-use permits, a faster approval system, by increasing the number of ports that can accept them, according to a draft proposal from the People's Bank of China. The central bank also plans to extend their validity to 9 months and remove limits on the number of times each permit can be used. China's PBOC extended its gold buying spree for a 10th month in August, while demand in the country for investment bars and coins has also remained resilient. Gold has surged by almost 40% this year on the back of central bank buying, rising geopolitical risks, and the prospect of U.S. interest rate cuts. The move to ease permit rules will enhance vitality and respond to external shocks by improving business environment at ports, according to the explanation to the proposal. The PBOC is seeking feedback until October 13. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Well, if you don't hold gold, and I suppose also silver, I mean, there are other things. In this sort of catastrophe, actually having the means of producing your own food actually does become rather important. Living in cities puts you at a great disadvantage because the distribution of the basics which we need, I mean, particularly food, that's going to break down. I mean, who with, sort of producing, whether it's vegetables or meat or whatever, is going to want to sell stuff into cities for people who can't afford to buy it? Well, sorry, cattle, you're going to live a bit longer, sort of thing. I mean, that is a real trouble. If you have credit, you'll get wiped out. It's as simple as that. I mean, think what 4 trillion marks were, if you like. I mean, it was some figure like, I can't remember, but I think before the war, the total money in circulation was measured in sort of, I think it was measured in billions of marks, of Reichsmarks, not trillions, even possibly millions. But I mean, it was a very, very low figure. So, if you've got unbacked fiat dollars, they're not going to buy you a cup of tea at the end of the day. On the other hand, if you've got gold, you can cash that in for worthless dollars, which you'll spend extremely quickly before they become even more worthless. I mean, that was the lesson really of that experience. And not only that, but if you do have gold, and particularly if you've got legal tender, it varies, the laws vary from country to country, but if you've got legal tender, then you can presumably use your gold to buy real estate, for example, or buy farmland, or nice country estates, or a hideaway away from anywhere, which might insulate you from trouble. But I mean, this is a very, very serious issue. It's going to be very damaging for virtually everybody because, let's face it, very few people actually have gold or have gold in any sort of meaningful way. Um, and I mean, we haven't even touched on problems that follow. I mean, if we pursue the analogy with Germany, of course, the complete collapse of the currency and the economy in 1923 led to political instability. It led actually to Nazism, Hitler, and all the rest of it, and World War II. So the idea that this is just going to get the whole thing out of get it out of the system, and then we can get on with lives. It's not that simple. It really is not. So you're going to continue to be very wary about the situation following what is now looking like going to be a great inflation yet again, a collapse of the currencies, fiat currencies. And the thing that is actually very worrying is I can't see how any politician in the West has the mandate to actually address the problem. And it's in that context we should be more sympathetic about the problems that the German political class felt or faced back in the early 1920s. I'm sure, and if you read into it, you will find that there were people who knew what they were doing. They knew that what they were doing was wrong, but they basically had no alternative. That was the way of it. And this was really what I think is an extraordinary situation. Markets are focusing on the next cut in interest rates. The one thing they are completely ignoring is what the rate of inflation, CPI, call it that, is likely to be in 2026. And I can tell you, it will be soaring. It will be rising very, very rapidly. Now, the reasons for that are basically a combination of things. But rather than go into, the effect of tariffs, which, of course, the Republicans will say, well, that's proving not to be in effect. But, it takes time for these things to work through. And the weakening dollar as well, that's another factor. You've got all these factors. But when you look at the, if you like, the credit background, look at the way in which we've got inflation. We are in a huge debt cum credit bubble. Now, when that starts imploding, what you're going to get is you are going to get a weakening dollar. The dollar is going to go down. Its purchasing power is going to go down. And if you like, the first signal we've got of that is the gold price measured in dollars rising. So we're talking about the relationship between real money without counterparty risk and credit. Secondly, we've got the long bond yield, which will break out above that 5.1% level, I think fairly shortly. Could be within weeks. And thirdly, we've got the extreme valuation disparity between the yield on the long bond and what's going on in equities, with the S&P hitting new highs. I mean, since that first peak at about 5.1% in the long bond, I mean, you would think, well, no, go back a little bit. When it broke out of a long-term downtrend of yields, I'm going back to 2022, around about early 2022, when it soared through 3%. We had, at that time, I think the S&P was around about 4,200, something like that. Now it's 6,500, despite the long bond yield continuing to rise. In other words, this is a bubble. Who cares about valuations? We're going to buy because it's rising. And you got the speculation in Bitcoin and all the rest of it. I mean, this is a speculator's market. It is a credit bubble. When that bursts, it's going to have a profound effect on the dollar.
In today's news recap, will silver's explosive rally drive prices to $50 this month? Silver climbed within striking distance of $42 an ounce on Monday, posting its strongest rally since 2011 as a deteriorating U.S. labor market reinforced expectations of a September Fed rate cut. The highly anticipated non-farm payrolls data confirmed a sharp slowdown in job creation, with unemployment unemployment rising to the highest level since 2021. Analysts at GSC Commodity Intelligence are now pricing in near 100% odds of a 25 basis point cut on September 17th. The possibility of a shock 50 basis point jumbo rate cut has also emerged, a move that could send precious metal prices into the stratosphere. Silver has already surged plus 47% year to date, more than doubling in value over the last 3 years. The momentum is unmistakably bullish. Data tracked by GSC Commodity Intelligence shows a steady rise in speculative longs, while flows into physical silver and ETFs continue to accelerate. Wall Street desks are openly discussing the possibility of $50 an ounce by year end if institutional allocation expands further. Every indicator we track is flashing green, says GSC Commodity Intelligence. Institutional positioning, ETF inflows, and physical demand are all converging to create what we believe is the most powerful setup for silver in more than a decade. Silver is not alone. Gold has already surged plus 35% in 2025, hitting a new all-time record high of $3,646 an ounce. Analysts at Goldman Sachs now forecast a run toward $5,000 an ounce. That's a plus 40% gain from current levels. For context, 1 ounce of gold was just $35 in 1971 when Nixon closed the gold window. Today's price represents a 103-fold increase over 5 decades. The verdict from GSC Commodity Intelligence is emphatic. Those who position now will capture what could be the most profitable super cycle of our generation. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Well, I've tried to get a mantra going, get out of credit. I know it's not easy. And you can't get out of credit totally because gold never actually circulates as money. And it hasn't really done since medieval times. It's credit which circulates, and people just don't understand this. So you have got to have some exposure to credit, but just make sure that you've protected yourself against the events which we've been discussing in this video. They are going to happen, and I think they're going to happen really in the not too distant future. Things move a lot more quickly today than they did in the 1920s. In the 1920s, you bought things with cash and then barrelloads of cash when cash lost its purchasing power. People wouldn't take checks from your bank account because it took 3 days to clear. And in 3 days, what happens to the value of that check? It just goes down with everything else. But nowadays, of course, payments are instant. It's electronic. So you don't quite have the same problems that we had at that time. Technology is advanced, obviously, from a banking point of view. Then you've got to consider whether your bank is safe. We know that the Fed's turned around and the Treasury's turned around and said, we will absolutely make certain that the banking system retains its integrity. We will not let banks fail. A failing bank will always be bought out and depositors will be protected. And they have to do that because the FDIC protection isn't enough, actually. It's a small part of the total liability. So, there are all sorts of things to think about. The main point, I think, is to understand what is going on and to have some gold. And that's why I've set up my Substack, to basically educate people who are not necessarily in the finance sector to really understand what's going on. Because you go to the finance sector and try and get advice on the future, and you will always get the same thing from people who themselves are totally ignorant of what's going on, what is happening to currency. They think currency is money, which it isn't. It's credit. It's just another form of credit. It's the highest form of credit. But when that goes, everything else goes. And, I can tell you that when I started doing this, I don't know, sort of 10 years ago, I came up with, understanding the way things were going. And I'm sorry to say I've been mainly correct. I haven't always been correct, mainly correct. Timing may be a bit ahead of events. People dismiss me as a conspiracy theorist. Every time I go and speak in the City of London, I find that there are fewer and fewer people in the audience who see me as a conspiracy theorist. So, they're beginning to think a bit more in the direction which I'm going. They haven't bought into it. If you go to them for advice, you won't get that advice, apart from anything else. They're educated by the government not to give the sort of advice, if you like, which you would get from someone who really does understand what's happening. And incidentally, we don't give investment advice. I mean, we just try and tell it as it is. So that's why I set up the Substack, and I'm glad to say that it's grown really quite rapidly. You get the full service if you go paid, which is what? Couple of Starbucks once a month, which I don't think is a major sacrifice. The more the merrier. And I just want to get the word out. I want people to understand what's going on so they can make their own decisions, which affects their future and the future of their families and those close to them in their.
What do you think of Macleod's take? Will gold continue to rise in the fourth quarter of 2025 and beyond? Are we approaching a major top in the global markets? Post in the comments section down below your honest opinion. Subscribe if you have not yet done so. And check this video right here because it's a perfect fit for you, and I'll see you on the other side. Thanks for watching.